What's going on, everybody? So, made this video on Instagram, and I didn't realize that it didn't stay on Instagram. It just kind of went away for the story. So I guess you can see it on the story, but I'm going to go back over it right here on YouTube, and that way you can kind of see a little better video, because that one I used a filter, and I don't know how it worked out. So, first of all, good morning. I love a good cup of coffee in the morning. We got an autofocus issue here. What's going on? There we go. So, hopefully it doesn't keep doing that. So, we're going to talk about Strangles and Straddles, option positions that I love playing with. So, the market is taking a very ugly turn right now. The majority of stocks are showing a lot of downtrend. So even if they're up on the day, you can look at a week or a month, and a lot of them are suffering. A lot looks like tech stocks. I am looking towards vice stocks like cannabis and things like that. So Tilray, Afria, Altria, Crone is still in the game. Switching over a little AMD, Ford. I love trading Ford. If you've watched any of my videos, you should know that for sure by now. Lev B is a good time, looks like, to rerun an old fishhook pattern I did before. It's priced back down to 305. They also do cannabis drinks, CBD drinks and stuff like that. They're getting into that. Now, also, Tilray, big cannabis company, the one that went from $50 to $100 to $200 to $300 in like a week, and then slowly declined back down. Now it's around 77. It touched the 60s the other day. Made a lot of profit on a one contract on playing a put on that. So I bought in for $1.40 or $1.50. I'm sorry, $1.50 one put contract for $40 call. I'm sorry, killing myself right now. $40 put. So it was $150 buy-in for that contract. Got one. Should have bought 3 or 4. But I did the one just to see kind of how it played out. And then by the next day, the value had went up to $350. And I got out at 320. So literally doubled it in one day. That's the power of options. And with a stock, there's almost no way you can do that unless the stock just retardedly just soars, out of nowhere, which nobody ever knows when that's going to happen for the most part. You got a lot of holders that bag hold a ton of stock, and then one day maybe it might just pop like that. But you can't really focus on that kind of thing, because if you do that, your portfolio will be locked up in the same thing for so long, unless it just so happens to boom, and I'm talking about more than a year. Anything a year or less is ultimately considered short term for the most part. Super short term is 6 months or less, and then really, really, really short term is like 3 months or less, or in the month range. So, what is a strangle? A strangle, hopefully you guys can see this chart, or, drawing. So a strangle. So you're going to buy a call, and you're going to buy a put for the same stock, same strike price, not same strike price, I'm sorry, same date, but above and below the current strike price. So your call, you want to be, in my opinion, you want to be deep in the money. You can take this farther out, across the spread. You can look down below and above to get slightly cheaper if you want, but to me that's more risky, because you're already putting your faith in the stock going up or down. So in this aspect, you don't really know what it's going to do, and we'll talk about a straddle in a minute. That's a similar feat. So anyway, we are buying a call. So in this example, I actually did this. In this example, this is not a recommendation. Please don't go do something you don't know what you're doing. This is purely educational. It's not financial advice. You can take what I do and apply it to your own education and your own learning skills and your own skills you already have. So, if you don't know what options are amazing. This is just one, and I'll talk about straddle. It'll be 2. There's multiple different types of options. You can just do regular calls, regular puts. You can buy a put. You can sell a put. You can buy a call. You can sell a call. You have debit credit spreads, you have credit spreads. This is a lot of different options that you can do. Now, I like to mitigate my risk. I don't like to just go all in, on something unless I know that it's really, really going to pay off in a very short term. That way I can just get it on and get it over with, right? So forward, I love doing these strangles. I did calls in the beginning just on forward because I watched the dips, and then I knew it was going to come back up and rebound, and it always did. But I've gotten a little safer with it, and I mitigated a lot more risk that way. So if you're into mitigating risk, then strangles and straddles are likely for you. So anyway, now that I'm thinking a little more clearly, strangle. So we're buying a call and buying a put on the same stock, same expiration date, all right? And in general, a put, you want time working on your side. So time is working against the other person in a put because you're the one that got it. So in the event that time runs out quickly and the stock's moving in your direction that you need it to down, then you're going to quickly want time to run out on them. That way your premium goes up and you can get out of the trade, hopefully with a profit. I don't like to break even. I think I said that before in a video. If I'm not making any money on profit, I mean, it's whatever. I'd rather not lose money, so that's the only stipulation to where you got out zero or back to where you were and you had no other choice, right? So say the stock just does something really, really crazy and you're out of time, and that takes away from that. So anyway, when you're buying a call, kind of rule of thumb is to go 3 to 4 to 5 months out. All right, see it 4 months, and the put was 1 month. So call's 4 month term. Why? Because time is working against you in this case, in which you want time to be on your side as it is when a put. So with the 4 month expiration, you have a lot longer for something to happen and recover from it. If you don't, then you're going to be stuck and you're going to be like, oh man, I just lost however much money, or you didn't make any money because you didn't have time to theta in your favor. So look a little closer just so you can see my sloppy writing. So same stock, same expiration date. We're buying a call and buying a put. And in this example, as you can see there, so the current price is say $12.15. We're using the example of Chrome. I don't know if I put that on here. I probably didn't. Anyway, this is an example of Chrome stock. It's a cannabis company that's moving along right now. So say the current price is $12.15. I'm going to buy a call at $12.50. I want to get closest to the strike price as I can, right? Because your break even is going to be some ridiculous, like say $14 or $15 to break even, which is absurd because if it reaches expiration, that's what's going to happen. Now, if you're above, the $12.15, you're not going to lose any money, but the option premium is probably not going to be what it was before. Say the stock jumps say tomorrow the stock jumped up. We're going to pretend this is December. We're going to say that this, I believe it expires April. So we're going to say that April is the expiration. So say like I bought 2 contracts for a call on Chrome and I was in the money at, this current stock price was like $8.50. I bought 2 contracts for a total of $297 and I cashed out literally 3 days later at about $605. And that was because the stock jumped on some news. It went from $8.70 that night, and it turned around and shot up. Took my limit order. I had a limit order already in place to sell at $300, so that took both contracts out for me, and $300 each, so that was $600. And it got accepted. I looked at it, I was like, well, that's awesome. So then I looked to see what the stock price actually did, and the stock price went up to, I think it touched $14 at one spot on a high trade, and then it settled back down, and now it's trending back. I think it's, let's see if I can pull it up real quick. I want to say it's at 11 and change right now. Yeah, 1140. So on my interactive trader platform, it's actually showing really good all the way across. Chrome is looking really strong. Hence why I did the Strangle on it. So actually, the Strangle I have, let me pull over Robinhood real quick. MNGA is just killing me right now. Magna Gas. So likely they're going to dig off into, unless they just explode real soon here, the reverse split's likely going to happen in the beginning of the year. And then I'll most likely get out of that stock altogether. So I don't like losing money. I'm only down, I think 20%. Let's see. Today's return. Hold on, let me get over here in this. There we go. Let's see. So total return is not good. See, what? I guess it doesn't have the same breakdown as when I'm on the phone. Anyway, so total breakdown, we're looking at M&J, I'm down a good bit. It's like 30%. Once it gets to 50, it's a guaranteed rule. You lose 50% on the stock, and you give it a few minutes or an hour to make sure it doesn't just rebound and it dip low to pick up somebody's limit order or stop loss or something like that. You get knocked out. Get out of it, in my opinion, because if you don't, you're just going to watch that sucker bleed all the way down to nothing. I've watched that before. Fortunately, it was only like $150 total, but I'm holding them in my Fidelity account just to see if they ever get back to where they were. And I know I'm a little off topic here, but it's just ridiculous. You know what I mean? It's like that's why there's rules in stock, trading in general, and a lot of people don't really, don't really go with that. And I disagree. I like to cover my bases, and I like to see. Oh, sorry, I'm clicking the wrong thing here. To return. There we go. All right, so now my options are looking up. Crone, what are you doing? Ah, here we go. So I've got the Strangle I've got running on Crone right now. I bought in for $330. I'm $22 down right now because the stock price is moving downward. We are looking at, I bought a $12.50 call, and I bought a $10 put. So in the event that the stock price plummets back to where it was before, $8.50, $9 range, I'll be in great condition. If it jumps up to $12, $13, $14 again, I'll also be in great condition. Now, the benefit of this is I'm watching this stock. Today, it has already went back up to $11.55, and now it's settling back down. It's still around $11.20. So somebody's totally day trading this right now. If they have a lot of money, they can just kill the stock. So I got two contracts. Like I said, it's one buy of a $12.50 call. And again, these expire in April. You want that expiration in your favor. And I have one put buy also for the same date, and that's at $10. So what we're looking at in this example here, not what I have on there. So in the event that the price jumps back up, boom, your premium is going to shoot through the roof. Now it's going to go down on the put because obviously the stock's going the opposite direction, so the value of this is going to decrease. The value of the call is going to increase. Therefore, check, see how much profit you made. I like to get out on Strangles 20 to 40%. A lot of times they're not going to rocket as high as a straight call or a put. You're limiting the amount that you can gain, but you're you're most certainly mitigating the amount of risk that you're taking because one, you got in this a lot cheaper. You can put a limit order to buy it at a lower price, and then if it gets accepted, amazing. That's what I always do. I do not like to see. I probably could have put this for a limit for like 310, 315, and it probably would have got accepted in the first day or so. But I bought in 330 because I wanted to go ahead and get in this position because I knew a lot of things were going on with Crone. So I didn't want to accidentally miss out. $15. It's really not that big of a deal overall when the overall position's 330. So with that being said, I'm currently watching it. Crone is just moving up and down. So anyway, so now that we kind of get this, all right, remember, rule of thumb. Calls, 4 months. Puts, 1 month. Strangles, straddles, 4 months. We want to go longer expiration on a position like this. And reason being is because, like I said, you want time in your favor. Even if the put decides to, increase position. And here's what you can do. You always can cash out before the expiration. You don't have to wait until April or whenever, whatever option you bought expires. You just cash out when you're profitable. You know what I mean? So in the event that you're up 25, 35, 40%, you can be like, okay, you know what, I'm happy with that. Let me get out this position, take that profit, and now you have a larger amount of capital or collateral, however you want to phrase it in the option world, and to put to work for in a different way. You don't want to let your money just sit there and sit there and sit there and sit there if it's not doing anything, right? So Ford has a lot of stuff going on. I got 2 straddles set up with them, and one I'm really strangling the price because I've got $9 call and $8.50 put, and the stock price on Ford is currently where are we at? Let me see. Ford is at $8.39 right now, so we're looking good. Let me go to the chart real quick, see what it's looking like. So overall, earnings per share $1.55. That's actually really nice. Looks like dividends are coming up. Let's see, dividend payout was December 3rd, so I'm in a perfect area for this because the dividend already got paid out. One thing you want to be careful with companies that pay dividends, especially a large dividend, if you're on the wrong side of that stock and your option trade, you will actually have to pay a dividend out of your profit or out of your account straight up. And you can read more about that. I recommend like Investopedia.com. You can get some more facts on that. So far, I see a lot of red and orange on here. The interactive trader platform is pretty awesome. Thinkorswim is cool, with TD Ameritrade. The only problem with TD Ameritrade, I would use their account all the time if they just lowered that trade fee. So $6.95 in, $6.95 out. It's just ridiculous. You're talking about $14 just on pure. Now, if you have $25, $50, $100,000 you're trading, it's not really going to bother you. But somebody with small trade accounts, they're not going to really lean towards going to TD Ameritrade, regardless of whether the Thinkorswim platform is better or nice or any of this stuff, because they're going to be looking at, oh man, I don't have, I buy a $50 trade and I'm already out freaking $14 right off the bat. So if you didn't make any kind of substantial profit on that, I even tested it. I did $250 that I put in the account. I made several great morning bell pump and dump schemes that were running for those notifications I was getting, I told about in earlier videos. And it was just terrible because I got in, I made all that profit, I day traded one trade, but by the time I got out, even though I was taking advantage of these huge jumps in the price, I got killed. I ended up paying like $85 worth of trade outs in end. It was like total fees for the day, commissions paid was $6.95, and it was like 6 or 7 times. Anyway, aside from all that, let's get back to it. So, Ford, I like to strangle the price really close because the Ford price tends to take a little bit of time, but when it does, it dips down hard. Like 818 was the last time it dipped super low, and then it shot back up. So, in my benefit, I want to be on either side of that fence, because if Ford decides to plummet to $7 again, guess what? I'm going to make money, and I'm going to cash out both options positions I have and be done with it. The cool thing about trading in these specific Strangles and Straddles, I haven't tried to separate the position to sell, just, let's see, 1250 call. Okay, so I'm on the online side on Robinhood. I love trading Robinhood because it's free. There's no fees. They were starting to do this checking account thing right now. They did have a big thing the other day. A lot of people are hating on it, but in reality, Fidelity locked up on me. I've had TD Ameritrade lock up on me. I had Fidelity black out on me when I was doing the day trades I was just talking about. I had Fidelity actually completely black out, and that's where all my money was. So in the event that my trade would have got taken for $1,000 or $2,000, $3,000, and then just the whole website was down for like 4.5 hours, what would I have done? I would have, because it went up and it turned around and went right back down. So I'd have bought right here and got out up here, but instead it would have been down there, and I probably would have lost easily half of my money. And that's just not something I was ready to do. A lot of people hating on Robinhood because the little outage they had the other day, something with crazy going on with options. So they just locked out a bunch of people's accounts because people were getting payouts that were not supposed to be paid out. Options accounts were getting over funded for what the return was supposed to be, et cetera, et cetera. Everything has glitches. Implied volatility is a huge factor when it comes to options, especially on Robinhood, I noticed. But you can actually see, you can do this experiment, you can actually watch. If you buy, per se, a call for a said position on Robinhood, and then you turn around and go buy the same position on Fidelity, you can actually watch the implied volatility go up when you put a limit sell price in there, because then the value implied is going to go up. And, nothing's really popping with the stock. It's artificial. It's not really anything. I watched it was F-Cell. I had $3 calls. The expiration was way out there, and the stock price got all the way to 290 something. And I tried to sell the option position 15 times, and I could never get out of it. So I literally lost, that position altogether. It expired at 0. And then a month later, the price went over $3. Joy. So I couldn't get out of the position. Now, that was because there was no implied volatility. There were no open interest really in it besides mine. So I had like 5 contracts, and it was like $45 total, and there was just nothing there. So right here, I'm watching this right now. Chrome dropped from let's see, it was 143, so $1.43 option call. So it was so that means the Chrome price just took a dive. Yep, go all the way back down to, let's see. Yep, went all the way to 11.12. Currently, Chrome is just diving down. So let me go back home and see where my position is actually at now. Reload. All right, so yeah, so that option position just took a nosedive. Like I said, we're going for $10. So once the price gets back to 8 or 9, we'll be great on Chrome. If it does not and it decides to go the opposite direction because a lot of the news they got going on, that's great. But one rule that I abide by, that I've learned from dealing with different types of spikes and understanding how people's orders get picked up and expire and things like that, or people's limit sales just to get out of the stock because they're scared it's going to keep going down, et cetera, et cetera. And you'll see very quickly that you'll walk yourself right out of your own money if you're not careful, because you're just in there, buying and selling, but you're selling fear. So in the event like this one stock I'm down, it's 34%, so it's $220. But this MNGA does this a lot. You know what I mean? I saw 4 consecutive days last week. Pre-market jumped way up. As soon as the market opened, boom, hit the floor. End of market day, boom, shot right back up. And if it didn't happen right at 4 o'clock, it happened at like 6 or 7 or 8. So that night I'm looking at it after hours, and then it just pops back up again. So I put a limit buy for like 15 cents per share, like 1,000 or 1,400 or whatever it was that I put a limit buy on. And if they get picked up, it'll lower my averaging down position. It'll lower me a lot further down. Average cost right now is 32 because I picked up a lot when it was. I thought it was going to maintain its spike and jump harder, but currently it looks like it might play back into the 3-month chart prior. So it was like 15, 16 cents per share, and then it shot back up again. So like I said, reverse split may end up taking place. I'm not going to be mad about that. It's happened to me before, and I'll just get out of the position then. Now, in the event that I somehow drop down to 50% loss, as I said, watch it, make sure it doesn't, pop right back up, and then get out of the position. So now, back to what we were talking about in the video. I think you all understand the strangles now. My shoulder is breaking over here. Let's see. Switch over to green. Hopefully everybody's still with us. Thank you for your patience. Let's see. We're going to... let's erase this and this. All right. Give me 1 second. Draw this up. Hopefully everybody's having a good day. So I'm going to read the definition for you here. A straddle in finance, straddle strategy refers to 2 transactions that share the same security with positions that offset one another. One holds long risk, the other short. Another definition to get a better understanding: simultaneous purchase of options to buy and to sell a security or commodity at a fixed price, allowing the purchaser to make a profit whether the price of the security or commodity goes up or down. All right. I somehow don't have internet. That's interesting. So in this event, we're going to straddle the price. And I have my phone on here, so we're going to... Why don't I have internet? Anyway, I'm trying to get this for you guys over here. Yay! So who loves when your internet connection goes out? I don't think anybody does. I'm just saying. So let's go to forward options real quick. Oh wow, I really don't have internet right now. What happened? Thank you, Spectrum, for ruining my my day right now. Let's see if we can connect. Give me 2 seconds, guys. Are we connected? What happened? All right, let's view all options. Yay, we're back. Okay, so we're going to go with, we're going to buy, call, and let's say, so right now we use this example with Ford. Let me modify my board here. That way we can have a, let's see, current price, 836, strike. You guys will be able to kind of understand what's happening right now. So we're going to, so I want to be in the money. We want to be call and put. So in this case, I'm going to buy a $8 call. All right. So currently we'll buy right in the money. So the premium for that is going to be much higher. Now, right now it's very short term. So it's $37, 37 cents times 100. So $37. Always remember that when you're looking at options. You always multiply because one contract is 100 shares. Try not to forget that. It's very important. So right here, we're looking at 37 for that one. We're going to go to the put side. And we're going to... so if you were to go for the put right here, your 850, which is just above the stock price currently, that would be a strangle. You'd be looking at... $18, and then that's going to put you into your strangle. Well, we're going to go back. We're going to sell this call, and the call is looking at 37, and now we're going to sell the put, and let's say, because the price is currently up and down, so it's looking like $8 is going to be, $7.50 is going to be your cheapest buy-in for literally $1 for the whole contract. But today it's already lost 50%, so you have to be careful. Well, we're going to go right there in the money because I don't think the stock price is going to dive to $7.50. So we're going to get the put for $8.50 because the current price is $8.36. But because we did $8 there, we're going to stick to it. We're going to do $8 here. Continue. That is a type of. Well, let's see. What am I doing wrong? Hold on. Give me just a second. I wonder why. Dun, 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 dun. Okay, so I got the one. Okay. All right. What am I doing? We need to buy it and we need to sell it at the same time. Oh, okay, I see. Why are they not letting me, what? Stand by. That's what I did. Okay, anyway, sorry guys, I'm so sorry for that terrible delay there. Okay, so what we have is, we bought a call and bought a put, so seemingly the same thing almost as a strangle, except for the only difference is the price is on the exact same price. So we did a $8 put and an $8 call. So for this particular, this is why I do the straddles, because I have the 850 and I have the 9, or I have the 850 and I have the 8. So when the price starts getting down below that area, so like right now my one straddle for expiring out in January is a strangle on Ford at $9 call, $8.50 put. So the stock price is currently $8.33 and steadily going down. So when I look back over my options in a week or so, the expiration is going to come very soon. So the further that price goes down, that option premium is going to go up. So likely my $8.50 put is going to make me the most money off of that. And you can watch some videos on YouTube on different ones. They have like kind of the drawing with the green and the red, kind of show you your entry, your loss, your profit. This one lost this much money, but this one made this much money, and you balance out and you see what your sum is in the end. So with that being said, we have $8 and $8. I'm actually buying both of these. So it doesn't necessarily, we're going to go review. Dun, 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 dun. Because it's so cheap. Okay. So, because the one is only $1, so it's crazy. So we are buying a call and a put for the same price, $8, and our total comes out to $37. So $1 for the $8 put and $36 for the call. And right there, you can see the difference in amount. So in the event that the stock price just shoots way down by today and drops down, and that happens a lot on option expirations. You gotta pay attention to that too, because you never want to buy short-term options because you will get burned very quickly and you will lose a lot of money. In some cases, you might be able to make a day trade slight type of return, but in a lot of cases, you're going to get burned. And if that happens, you're going to be in trouble, because on the day before expiration, so today, you'd probably get a notice saying that your options expire tomorrow, and you won't be able to do anything. You can attempt to sell them, but that next day, you won't be able to touch them at all. And because the option house is going to have control of it, and they're going to be matching and selling and buying and all this other good stuff. So, with that being said, your total cost would be, we'll do this, 36 and 1 combine equals 37. And remember, that's $37. Try to do this where you folks can see. Okay. You have to excuse my terrible writing here. Using markers. So, okay, super sloppy. Straddle. Expiration, we're going to stick with 4 months. We do not want to go the 1 month route, because you're looking at a lot more risk against you. The 4 months gives you a lot of time. So I am curious to see what the value of that straddle would actually come out to. Now, I kind of sort of did a straddle in another sense by doing a FRIA, which is I went ahead and bought a $5 call and a $5 put. And I should have cashed out yesterday. It gave me like a $50 profit on the call because the stock price shot up to, what was it? Let's see. It went up to 150 and some change. I should have sold it. That would have been a clean $40 profit on the call, and I could have just got right back into it when the price dove back down. Anyway, so straddle, 4 month expiration. We're buying a call and buying a put, just like a strangle. However, the only difference is we're buying the exact same price. We're buying a call at 8 and we're buying a put at 8. Current stock price $8.36 and slowly declining. Hopefully, it continues to go down. With that being said, we're looking at, hopefully the premium. Let's see what my 850 is looking like. All right, so yeah, so I'm currently breaking even. Expiration's January 25 on the Ford, the $9 call, $8.50 put strangle. Currently still sitting at 0. Nothing's really went up or down far enough for it to really affect the price, so to speak, because it doesn't expire right now. So that put is going to increase in premium value a lot when it gets closer to January. So once January 1st pops over, it'll be 2.5 weeks, and then expiration is going to hit. And worst case scenario, I'm going to get out kind of at, breaking even, or I'll try my best to get to, at least $5, $10, $20, something like that profit. So one thing it does show you when you're on the website, and should show you on your phone too if you're on Robinhood, and other brokers just show you this anyway. Before break-even prices, you're looking at so remember it was a $9 call, $8.50 put, so the price would have to go up to $9.74 $9.76 just for me to break even, and $7.74 just for me to break even going down. Now, if I waited for that to happen, then you're telling me that I wouldn't make any money, and the price could dive all the way down to $7.74 per share, or go up to $9.76 per share, which is just ridiculous. So what I'm going to do is I'm going to wait and watch the price, depending on which method it goes, up or down to a certain extent. So say it goes to, if it gets up to like $9.15, $9.20, then I guarantee the option price on that call is going to go up a lot higher than what it is now. Yes, the put will go back down, but whichever one is higher on that date, so say it's over $9, So how the option works is if it expires under 9, if they're not 9 or more, then you're not going to make any money. It's going to expire 0. If it is 850 or above, then you're not going to make any money because it needs to be below 850 for it to be the proper put. So the difference in that price there, the break-even price, is how much you paid for the option. So currently, it's going off of the entry prices that I paid, and that is your break-even prices. So it basically subtracts whatever the total cost minus your actual cost, and gives you the sum there. Anyway, so hopefully you understand this. I know I've been talking a lot in this video. I don't know how long it's been. It's probably like 45 minutes or some crazy something. 35 minutes looks like. So Strangle, Straddles, my 2 favorite positions to play. I actually got asked by a guy in a chat that was, would it not be better to do, I think it was a credit debit spread, and basically the entry cost was just slightly cheaper going that route. But as far as mitigating the risk, I mean, you kind of have the same thing because you're doing a similar setup. You're just buying 2 calls far away from each other or 2 puts far away from each other, so you kind of get to fill the gap in between. And whichever one gets the most improvement is obviously the one you're going to make profit on. So being in the money is the best way to trade options, in my opinion. I used to be the cheap trader in the beginning, and I realized it wasn't going to do anything for me because I literally only got lucky a few times. Now, I'm not saying, you can't trade way out of the money, and then it happened in your benefit. Some crazy something like Tilray, in the beginning when the stock price was $23, $30, October rolled around, that sucker hit $300. If you bought an option for that, I mean, you could have bought an option for $150 for like $2, and then turn around and sold it for $1,000. Probably 2 weeks later after that happened. Just like right now, my current position in Tilray for the $40 put that I did, because I knew the price was going to do some manipulation there because a lot of things happened and a lot of rumors were going around that they were going to combine with different companies and stuff. So I went ahead and took my profit. Granted, it is actually still worth a little more than what I cashed out from. It was worth $320 when I cashed out. Currently, it's worth $440. So that's okay. I'm not mad about that. I'm just going to accept what I got because I got a huge profit off of it. I made 100-something%, 130% return. You can't. Why would you argue with that? You know what I mean? I mean, if you want to be greedy and stick in there and see what happens, well, what happens if Tilray would have just flew right back up to $150, $300, on this news with Anheuser-Busch or whoever, and you would have just went to 0 when you could have cashed out 100%. I've done it. Don't do it. So, with that being said, hopefully you guys understand the straddle and the strangle we talked about first. They're very similar. Try not to confuse them, but a lot of times you will actually see, like Robinhood, for example, when you pick the right, positions to create this position or option type trade, it'll actually tell you what it is in the little box above it. It'll say 2 option order, 4 option order. You can even put them. You can place iron condors in here. You can place credit debit spreads. You can place strangles, straddles, and all of these different ones. You can do all that stuff. So remember your rules: 4 months calls, 1 month puts, straddles and strangles, 4 months. Don't go no 1 month expiration unless you really, really have some faith that whatever